Good morning. I'd like to welcome y'all to the November 14th, 2022 Oklahoma City Post-Employment Benefit Trust meeting. We'll go to item number 2, approval of the minutes. Amy's doing her magic here. Got a motion and approval. Record your votes. Motion passes. Item 3 is elect a vice chair trustee to preside at trust meetings to perform chair trustee duties in the absence of the chair trustee. I would take nominations.
I would like to, is my mic on? I would like to nominate Laura Johnson, but she's not here, so hopefully she'll accept the nomination.
Okay. All right. We got a nomination. I'll consider that as a motion. Do I have a second? You gonna fix that? Okay. There we go. Have a motion and a second. Record your votes. And the motion is approved unanimously. All right. Item number 4 is presentation of investment performance review for the period ending September 30th, 2022. We have Doug Anderson from ANCO. Mr. Anderson.
Good morning, Mr. Chairman and trustees. So I think everybody knows this will not be the most uplifting report that we've seen. Markets continue to be difficult. The nice thing that we have seen, though, recently is some recovery. So I'm going to go through this report. I'm going to do sort of the shorter version of it because we have an October 31 update. But please stop me with questions anytime during the report. Briefly, the market environment, and if we could go that slide right there. The issues that we faced in the first and the second quarters were largely intact in the third quarter, which means inflation, supply chain issues related to both the conflict in Europe and to China's zero COVID policy. The Federal Reserve raising interest rates at the fastest level that we have seen, 75 basis points at a crack. 4 times this year, we've seen interest rates go from the Fed funds rate about 0 to almost 4% already this year. And the fallout of that to normal human beings is that mortgage that you could have gotten for about 2% last year for a home is up to close to 8% now. And we're seeing the fallout of that, not just in housing, but in cars. What was it, 2 years ago, it was almost impossible to buy a used car. In fact, some used cars were selling for more than the current year version of it, and we're seeing a massive slowdown in all of those. Federal Reserve sees inflation at almost 8%, thinks that they have to slow down economic activity, and how do they do that? They do it by increasing the cost of time in interest rates and causing people to, or business folks and governments to slow down their spending. So a slowdown is inevitable. We don't know how harsh of a landing it will be. Earlier this year, it was, I remember folks saying, well, we'll see a recession during the third and fourth quarter of this year. It hasn't happened. The third quarter was a positive quarter economically. The fourth quarter, as of now, the Federal Reserve Bank of Atlanta is expecting 4% real growth during the fourth quarter. That is not what the Federal Reserve wants to see. So probably the next time we see them meeting, they'll be raising interest rates again. So that marks a difficult period for investors. Do you want to invest in equities? Do you want to invest in fixed income, U.S., non-U.S., et cetera, energy? And energy and agriculture are 2 of the best performing sectors of the marketplace, which has not been the case for some time. I don't know how much you've been watching the news about technology stocks. Facebook is down 75% this year. Microsoft is down. Amazon is down. Apple is down only about 6 or 7% because they're mostly consumer staples. And if you've been watching the cryptocurrency market, that's incredibly complex and dangerous place right now. On Friday, there was an exchange, if you will, crypto exchange, filed bankruptcy And it is a larger bankruptcy than Enron, if you can believe it. Enron used to be the world-class standard of bankruptcies, but FTX has now won up to that, and it's getting so very little play in the markets. It's hard to believe. So that's where we are right now. I'm going to go a couple of, yes?
We don't have any exposure.
None.
Okay.
No.
Just want
It's,
to make sure for those who are listening or watching.
It's very interesting because I mean, this obviously is a strange company, but it appears that the venture capital world, right, in the herd mentality that they have, and also private equity dipping down into venture capital, trying to sign the deals as fast as possible. This company was extraordinarily large, under the radar. They did not have a board of directors, despite taking a ton of money, right? They were borrowing money in billion-dollar chunks with no collateral. I mean, greed gets the best of some of the smartest people in the world, and I think the venture capital community has got a lot of egg on their face for this. So it'll be interesting to see how this shakes out. But remember, FTX, I think that they had a sports stadium named after them. They spent $2 million on Super Bowl ads last year. And now it's gone, and nobody can really pin down where the founder is. But they were getting a lot of funding from institutional investors, not like us, right, but by the venture capital community, which, you know, they always couch it by saying for every 9 total losses, we have 1 that hits it out of the park. But I find it really hard to believe that they were giving that much funding to a company with no board of directors, with an investment arm that was siphoning money off from the new bank, if you will. And there will be regulation. It'll be an interesting story. There'll be a movie written about it. The best thing I heard about it is that, Michael Lewis, the author, allegedly spent 6 months with the founder earlier this year, or last year. So that'll be an interesting insight when that book comes out. So that's the conspiracy and the weirdness that we've been seeing in the market, and honestly, it's kind of late stage technology bubble. Remember that the last big bubble in the markets, technology, was about 20 years ago, so we're probably in another 20-year cycle, and we'll see something again. But there is definite wealth destruction going on in that part of the world. Luckily, our investments are much more prudent than those. Doesn't mean that we can't lose money. It doesn't mean that we haven't seen drawdown this year, but nothing like that. So next slide. This is performance for the markets, the major markets. The S&P was down 5% during the quarter. International equities were down closer to 10%. That was a lot due because the dollar is the strongest currency in the world versus everything else. That's because we're the safest, or at least perceived to be the safest. Now, the really painful part of this year's market environment, I know we see losses in equities, but you see the green columns there for the quarter. You see that the Bloomberg aggregate was down almost 5%. It was down almost the same amount as equities. These are bonds. Bonds are not supposed to be down 12% in a year. I think I've said it before. This is the worst year for bonds in the United States since the Civil War, and it's the worst since it is comparable to when the world thought that the United States would never be a thing. So 1778, we saw similar bond market performance in the United States because the world thought that this experimental new government was not going to work. So we're in an environment that looks like, performance-wise, like there's an existential threat to the bond markets, which it's not. Bonds are being repriced to a new paradigm of inflation. And the upside to that is that when you're reviewing capital market assumptions or return assumptions going forward, it's the time of year that we're seeing the new ones coming out. They are substantially higher going forward than they were a year ago. So we have seen the bond market repriced to an area. I have clients who have allocations in money market funds, which are still yielding roughly 0 because the banks are not increasing those rates right now. But you're seeing a 7-month CD with a yield of almost 4%. So the yields are getting much, much higher, and we have more choice in where to invest now, I think. So next slide is going to be equity market performance. So this is all sizes of equities in the United States and the three major styles: value, core, and growth. And you'll see while growth outperformed for the quarter, over the last year, value has done much better. What is value? Typically, a lot of energy stocks, a lot of banks, a lot of materials, a lot of insurance companies. So things that are going to be doing better in this environment we're in, that I'm calling back to basics. I mean, if you look at what is driving the news cycle right now, it is not the newest app or the newest feature on Facebook or Apple iPhone. It is how much is my gas bill going to be this month, if I can buy it in some places. And that market is evolving very quickly. So next slide. This is very interesting. This is through September 30. And I want you to pay attention to the top chart. That's the Russell 1000. These are the biggest 1,000 stocks in the United States by capitalization. Performance for the quarter is in the dark blue column for each of those sectors. The one-year return is in the light blue. If we look at this, you see the listing of the sectors down the left-hand side. The number in parentheses is how much of the index that composes, right? So when I look at communication services, that's 8% of the index at the end of the quarter. If I look down that list, I see a lot of negatives for the year. In fact, communication services down almost 40%, and I see two positive: utilities and energy. Those are utilities are, that's about the yield on a utility stock right now. We have to have those utilities. These are electrical utilities for the most part. Yes, so that would be, I think Facebook is in there. They've repriced, they've reallocated those. So that used to be technology, but now since it is communication services.
Doug, I'm sure you're probably going to get there, but I'm like impatient. How much of our portfolio is invested in these utilities and the energy companies?
Not a lot in utilities, but more than average in energy. And we'll get to that in a second. That's a great question. So we're looking at this through September 30, 46.5% return in energy, right? That's great. The month of October was up another 20%. So the delta that you're seeing between energy and communication services over the past year is over 100%. And I want to remind everybody that 2 years ago, communication services and technology were never going to underperform, and energy was dead money forever. So how quickly things can turn, and if nothing else, we have to have energy, right? We'll probably be moving to other sources in the future, but as of now, this winter, next winter, we have to have energy. Luckily, where we live, that's good for us for once in a while. So next slide. I'm not going to talk about this one. I want to go through international equity very briefly, which is the next slide here. You can see a lot of negatives here, but on the one area, emerging markets, Latin America has done well over the last year. This is the quarter and the year. I'm sorry, this is for the year, the quarter at the top, the year at the bottom. Marginally positive in one area. You'll see US dollar returns are much worse than local currency returns. That's because folks are flocking to the US dollar because it's the safest currency in the world. And one more slide here. I'm going to talk about fixed income. Next one, please. This is truly painful. Like I said, bonds are not supposed to be down 12%, much less 14%. We have seen some normalization of interest rates. Going forward, our expectation for interest rates returns is much higher than it was, given the fact that we have going forward yields on the aggregate of 6%. Can't remember the last time the aggregate index had a return or had a yield of 6%. It's been over a decade. But looking forward, we do have that part of the portfolio with the ability to provide positive returns going forward. So the losses that we've seen, remember, bonds are effectively contracts, right? I'm going to lend you money today. You're going to pay me back interest over the term of it, and then at the end, you're going to give me the principal back. So the losses we have seen have not been crystallized, and they will be made up over time until maturity. But bonds are not supposed to be down like this. But if you start with almost zero yields across the yield curve and you see inflation, it's going to be painful. We have not seen massive repricing of corporate bonds because the bond market has become so dominated by sovereign and government bonds, given what happened during COVID and all of the money printing that happened then. So if anything, corporate debt has been able to take advantage of lower interest rates over this time. However, they have been repriced lower. Next slide is the yield curve. On the bottom there, or on the top, you can see trailing market rates. The gray area that starts at 0 and goes up to better than 3%. This was as of September 30. So that's the Fed funds rate. The Fed fund meets, they say we're going to increase interest rates. Those are 75 basis point hikes. Normally they're 25 or 50. It tells you how aggressive the Federal Reserve is being fighting inflation right now. And the bottom you can see the blue line is the yield curve. So that's the interest rate on Treasury bonds of various maturities there. You can see the entire yield curve is below 2%. Now the entire yield curve is above or almost above 3%. It is now after the last Federal Reserve board meeting. But you will see that the yield curve has shifted higher and it's flattened out. So you're not getting that much more interest for holding a 30-year bond than you are of a 10-year bond. In fact, there are inversions throughout the curve, which makes it very difficult for companies to borrow productively. Next slide is going to be the total fund down 18.3% over the trailing year. This is what happens when equities go down and bonds go down at the same time. I will spoil some of the good news, but over the last week, the portfolio is up 5.5% because the market has come back. Over the last month, it's up almost 10%. So our trailing year return has improved to down 14% over this period of time. But this is a very difficult period to be a 60-40-ish investor because bonds did not do what they traditionally do, and they didn't do what we intended them to do when we diversified out of them. Next slide. Next, please. This is the impact of the total loss throughout this year. Also, look back at the previous downturns that we have had. There are no periods where there are 3 quarters in a row that we've had negative returns like this. If you see the total return over time is 122%, but the gain loss figure has been moved much lower this year. It's been a tough year. Next slide. Our asset allocation is roughly stable right now. You can see that one thing I want to point out, in 2018, the fourth quarter of 2018, we had an equity market sell-off. In the first quarter of 2020, we had an equity market sell-off. This year, we have an equity and a bond market sell-off. What's different here? You don't see the sharp decline in equities versus fixed income because everything has gone down this year. In the years in 2018 and in 2020, it was obviously COVID. You see the fixed income exposure spike because it did what it was supposed to at that time. Next slide. Allocation is 63% domestic equity, 10% international equity, and the rest is fixed income. Go to the next slide. These are the managers that we have. Trustee Barry, the biggest allocation to energy is in the Hotchkiss and Wiley mid-cap portfolio. Causeway did have some exposure to energy, European energy companies, but they did realize profits in that area, and they've redeployed that. The mid-cap index has some energy. The Fidelity 500 index does have some energy, but the biggest active exposure that we have is in that Hotchkiss and Wiley portfolio. Next slide, please. I'm going to ask you to skip a couple more in the interest of time. Back, there you go. So here are the total, actually a couple more back. No, there you go, perfect. So the total fund, a loss of 18.3%. If we go down the list here, fixed income, again, we don't like to see losses of this. This is 99th percentile. When we do any type of portfolio simulation, this is as bad as fixed income can get. I'll have a slide to show you later that in similar periods, well, there is no similar period, but in previous market drawdowns for bonds, what returns look like going forward. I'll be able to show you that. Our entire bond portfolio, 18.94% loss. You can see that pushes our fixed income allocation to losses over the last 3 years, 5 years. 7 years were positive. Going down the list for the trailing 1 year, Loomis Sayles was down 14%, Double Line was down 14%, Lord Abbett was down 16%, and really the toughest one here is Hoisington, down 29%. Remember, they hold treasuries. They hold the lowest credit risk bond out there. They just hold them in long duration form. So they're holding 30-year treasury bonds. So when interest rates kick up like they have, it can be very negative. Remember in 2018 and then 2020 when we had equity market drawdowns, this portfolio went the opposite direction. So equity market down 20%, this portfolio was up 20%. They got the call wrong on this one. I'm going to say that we place them on the watch list today for the indefinite future. If we look at, it's not good news, it's not great for anything, but our two core bond portfolios, so that's Loomis Sayles and Double Line, they were in the top quartile of their peers. That's faint comfort to me when we see losses like this. So going down on our equity portfolio, our two index funds tracking the market as they should. Trustee Barry, Hotchkiss and Wiley, you can see their returns here. Index is down 13%, they're down 5%. That's in the first percentile of their universe, primarily because of energy. If you look at their return over the last 3 years, they're up 9.82%, doubled their benchmark, first percentile. 2 years ago, when technology was leading the world, the S&P was great. This was one that we're talking about looking at alternatives. But it's a unique process. I think they do a great job. They try your patience from time to time, but they've done very well this time. Next slide, please. Stevens is a high-tech, not a high-tech, but a small-cap growth fund. You can see that they've suffered along with their market. Longer-term results are top quartile. And then Causeway International Value, so this is value stocks, and they're slightly better than their index. I want to look at the next slide briefly, just taking a look. This is calendar year returns for the portfolio and the funds. You can see that the year 2021, fund was up 17%. The year 2020, remember that's COVID, right? 2020 was COVID. Portfolio is up 15.9%. 2019, we're up 22.25%. So we're down this year. Fortunately, we had 3 really strong years building up to this. If we're looking at our portfolios year by year, Loomis Sayles has they have a very high return, and then they have, in relative terms, and they're fairly low. I'm surprised they've done as well as they have this year, but I'm pleased about that. Double Line, similar, but a little bit less volatile there. Lord Abbett is a high-yield bond manager, their returns. One thing I like about this portfolio going forward is the yield on it's about 9%, which it's been a long time since we've had that. And then looking at Hoisington, you see where they are in the greater perspective. They do not have bond market-like returns most of the time because they're an unusual portfolio. And then looking at our portfolios on the equity side. Remember, we switched the S&P 500 index to the Fidelity because it was less expensive. So we don't have long-term returns there, although it does track the market. We don't have the actual returns. But then look at our mid-cap value equity portfolio. Looks great this year. The year before, it was fantastic, up almost 40%. Not so great in 2020 and in 2019. It was up 13%, while its index was up 27%. And you can see 2018, they suffered pretty badly there. So our patience has been compensated there for assuming that risk. And then the next slide is going to be our small cap and our international value. Not a ton of stuff here except for the Stevens does better in a well-rounded growth market, not one that's focused on technology only. And you have to go back to 2018 for that. And Causeway is, their value, so if the market is focusing on cheaper companies, they'll do better. A couple more slides here from a fiduciary perspective. I'm going to make a big page jump here beyond these slides, if you can run through those until we see something that looks different. A couple more, please. This table shows you the correlation of the assets. Hoisington is our anti-correlated, so it's supposed to do well when other things are doing bad, but over the last 5 years, because of what's happened this year, the correlation has tightened up pretty significantly. Next slide, please. This is the status summary. Hoisington is going to be on the watch list now, so they're on alert moving forward. That's the only fund that I recommend doing that for today. And then fees are on the next slide. Very important here to see the expense ratio of the funds that we're investing in is 44 basis points. The category average for all of those categories is 90 if we weight it by where the assets are, which means that we're less than half as expensive as the median fund out there. That's good from a fiduciary perspective. I don't think we're giving up any quality for that. And then that saves, if you will, $326,000 per year. So next slide. These are our dashboards. Nothing unexpected here. One more, please. We would love to see everything in the yes columns here. This is our compliance checklist, but we do have some that are in the no or not applicable, but there's nothing that's really standing out here other than the Hoisington underperformance. And then next slide. That's our asset allocation. So that concludes the September 30 report. Hopefully this is the darkest before the dawn quarter. We have seen some pretty remarkable improvement since the end of the quarter. Most folks think that October is the worst month for the market. Actually, it's September historically, and more bear markets end in October than any other month. And if you want your horoscope, that's about worth about the same as market history. So happy to take any questions.
Any questions for Doug? All right, there's no action on item number 4, so then item number 5 is receive the monthly investment flash reports for August 31st, September 30th, and October 31st. Were you wanting to go over October 31st?
I would like to.
Yes, okay. Please do
Briefly
so.
go over October. There it is. Thank you. When we're looking at the year, it's not great. We would still go over to the year-to-date column on that table. Negatives across the board, pretty substantial negatives. But you do see in October that we had a nice increase here. It's not the first time this year that we've seen a recovery. The first quarter saw, right after the end of the first quarter, we saw a recovery. The second quarter we did not, but we're seeing one now. Again, looking at the results here, the Russell 1000 was up 8%, the Russell 2000 was up 11%. International is actually positive, but unfortunately bonds were down less than they had been, but down. And if we look at the sectors, energy, like I said, up 24% for the quarter. They're up 68% for the year. And again, this is a sector that the world despised 2 years ago. Last year it did great. This year it did great also. Next slide, please. So this is not picking up a whole lot of the return, but you did see that the return was positive. I'll have to check into that. I did check, so that's showing a market value of $84 million. As of last Friday, market value had increased to $87 million, so we're gradually working our way higher. Next slide, please. You can see the returns here. It's not a lot different for the month, except for it's positive. Our bond portfolios were negative. Luma sales did better for the quarter. We look at the trailing year, we're still down substantially. You can see Lord Abbett, the high yield bond. So this is an equity bond, sort of a mix. It was positive on the month. Hoisington down. Also, we've finally seen the 30-year go from a yield of about 4.3% down to about 4% so far over the last week because there was an inflation print that came out better than expected. Looking at our equity portfolios that drove the return during the quarter or during the month, and the S&P was up 8, the mid-cap index was up 8.5. Hotchkiss doing what they have been doing, up 16.5. And you look at their return over the trailing 1 year, it's not unusual to see them outperform by that substantial of a margin when they're on, but to be positive when their index is negative gives you an idea of how different they are than the benchmark right now. And you can see we even had positive return for our small cap and our international value equity portfolio. So 84 million at the end of October. Here we are on the 14th of November. We're up a little bit more, but I don't know when the volatility will end. And honestly, for a bear market, volatility has been relatively low this time. We've just had a lot of negative 1% down days rather than a few negative 3, 4, 5% days. But remember, volatility does cluster. So we see down days, if they get really sharp, soon after, that's usually when we see the very strong upturn. There are a couple of other slides I wanted to show, and I think they might be just past this one. I was looking through the board packet. This is the one right here. Yeah, this is the section. And if I could indulge just a few more minutes here, market history on what the recent past has looked like. So we go back to October of 2007. That was the beginning of the great financial crisis, and you can see that over that period of time, from October 9th, 2007, it took until 2012 to regain the previous peak for the S&P 500. So we were down from October until December of 07. Actually, it was in March of 09 that it turned, and when it did turn, it was pretty quickly. But that was I used it before, but that was a significant threat and doubt that the international financial world would continue. Instead of FTX going bankrupt, it was Lehman Brothers. Those were tremendously bad days when the Federal Reserve actually had to jump in and make sure that the financial system would not turn the lights out forever. You look at our bear markets here that we've had since 2000. You can see, since 2020, the first quarter was down 33.79% of COVID, and then market leapt back much higher, and you can see that where we are, it has been down and then up and then down and then up and then up again where we are today. Next slide, please. This is the chart that I like to show. So this goes from 2007 until 2020, so 2022, so this is 15 years. This is every day what the market has done. This is a compilation of it. So all trading days from the top of the market before the great financial crisis. If you'd stayed in the market all of those days, 3,771 days, your total return would have been annualized at 7.86. If you missed the 5 best days, return over that entire period of time goes from 786 down to 461. That's 5 days. And guess what? Those 5 days happened very close to the bottom of all of those markets. So the temptation is when things get very tough, we're going to sell out of the market. And what happens if you did that? If you miss the 5 best days, you're down to 4.6 annualized. If you miss the 10 best days, you're 2.39. If you miss the 20 best days over all 3,771, you're worst market timer in the history of the world, but your return actually goes negative over that period of time. So time is our friend. We're long-term investors. We can take advantage of this. Next slide, please. So this is the percentage of positive and negative rolling period returns. These are rolling 1 year, 3 year, 5 year, 10 year, and 20 year. And what this chart shows is that if we are patient enough, if we have a long enough outcome, if we have a long enough horizon to our investments, equities actually aren't that risky. If we have 20 years, which I think a trust like this does, 100% of the 20-year rolling period returns from 1926 to the present have been positive. I can't say that this is going to be the fact going forward, but I do think that this sets the stage that equities are a good long-term investment, despite short-term volatility. And that's 922 rolling 20-year periods. And the average annual return is 10.81%. Next slide, please. This is the S&P 500 rolling 20-year return. So this is what it looks like when we plot every 20-year period, when we roll it forward over this. And you can see that we had a huge peak in the early 1960s. We saw one in 1950. We had one in 2000, right? So that was the internet bubble lead up. And then to 2022, pretty modest here in the overall history of it. But notice, there are 0 20% returns that are negative over this period of time. So if you were patient enough, you can see that you were rewarded. Next slide, please. All right, this is a new one, and this is special because of how bad this year has been for bonds. We go all the way back to 1976. Believe it or not, there is not a bond market index that has good pricing beyond 1976 because bonds are not, it's not an exchange, it's a market, right? So all these places have, all these big banks and brokerages have inventory, but they don't have a ticker like you do on equities. So where are we right now? We're down 16%, super painful through the end of September. The only periods of time in the history of this index that we have had drawdowns worse than 5%, you can see them, 1980, 1981, 1994. So 1980 and 81 were oil price shocks, right? Inflation, boom, that pushes bond prices lower. 1994 was an international debt crisis, which sold bonds off throughout the world. But you can see how long these drawdowns were. 8-month drawdown, 3-month recovery in 1980, September, 15-month drawdown, 2-month recovery to get back to where they were. And then 1994, 5-month drawdown, 8-month recovery. We've had a 26-month drawdown on bonds right now. So this is without precedent, you might say. Now, looking at those previous periods of time, when you get to the bottom, and again, this is market timing when we're looking back, but what did the bond market, what did the bond index do looking forward? So from the bottom, over the next 1 year, you can see the returns, 10.5%, 34.5%, 12.5%. Next 2 years, annualized rate of return, you can see next 5 years, annualized rates of return, pretty substantial. So bond markets can recover also. And those recoveries can be relatively long-lived off of the bottom like this. So next slide, please. This shows drawdowns in excess of 20% more for the S&P 500, what we're looking at. So we're jumping back into equities, 1950 to present. So from the drawdowns of excess of 20%, that means peak to trough, you can see the cumulative rates of return for the S&P 500 from the bottom there, and you can see over the next 5 years, you're 59% cumulative. This is not annualized. If we look at the percentage of returns that are positive from the bottom, 66%, the 3 months after that are positive, 72% 6-month returns, 80% 9-month, 87% 1-year rates of return. So that's better than average if you're putting money to work in the market. You have a better than average chance of making money if you're investing when the market is down. So I think that's the last slide in this bunch. Now this is one more. It's pretty complicated, but when you see percentage of trading days that are above or below 1% gain, like I said, this latest one has not seen a whole bunch of days with huge volatility, but we've been more moderate volatility, but just more consistently. You can see the very bottom chart there shows you the percentage of trading days that are below average or losses for the S&P over time, either annual observations. 1929, that's a pretty bad year for the market. You can see that 56% of those returns, roughly, were negative. 1974, 57. You can see 2000, it inched up there. In 2022, we're right up there with the biggest proportion of trading days that are below, that are negative, but we're not seeing those huge, huge down days very often this year. So market history lesson completed. I'm happy to take any questions about that.
Are these slides in our packet?
Yes,
Awesome.
they are.
All right, I'd entertain a motion to receive the monthly investment flash reports. Motion. Second. Record your vote. And it passes unanimously. Thank you, Doug.
Thank you, Mr. Chairman and trustees.
Item 7 is receive the calendar year 2023. Item 6, we need to ratify the claims. Got a motion and a second. Record your votes. And it passes unanimously. Now to item 7, we're going to receive the calendar year 2023 meeting schedule. Motion and second. Record your vote. And it passes unanimously. Item number 8, we're going to receive our annual actuarial report. And today we have John Mallows from Nyhart here to go over our report. Welcome, John.
Morning, Chairman and Trustees. Yeah, I'm John Mallows from Nyhart. I'm going to try to just hit the key points in this report and try to keep it as brief as I can. So let's start off on page 5. And page 5 shows how you got from last year's liability to this year's liability. And it's mostly good news this year from the actual report point of view. So we started at the start of the year at $515 million, and this is the city. And then we added service costs of about $15 million, and the service cost is the cost of the actives accruing 1 more year service and getting 1 year closer to retirement, so there's a cost to that. And then on top of that, there's the interest cost of $17.6 million, which is kind of like just interest on a mortgage. And then we get to the change in assumptions, which is kind of the big change this year. As interest rates go up, liabilities go down. So since the interest rates went up, quite a bit this year, there's actually a decrease of $103 million in the liability because I think the rate went from let's see, this 3.5 to 5. I don't. That's on a future page. I'll get to it later. But yeah. So that was a huge change this year. Also, a change in assumptions. There was we updated the trend rates. We do a study every year and then look at trend rates, surveys, and what other actuaries are doing. So we updated that as well. And they're the only 2 assumptions that changed. But the discount rate had a big impact. Next, there's a difference between actual and expected experience, and that is due to claims experience actually came in better than expected. So there's and we updated the census data. We refreshed the census data. So the combination of those 2 things decreased the liabilities by $50 million. And then the last item is benefit payments. We paid out $11.3 million in benefit payments, and that releases the liability. So that's another decrease. So net effect of all these things is a decrease in liability of $131 million. Now, you did lose a bit on assets. It went from $96 million to $84 million. And I just want to point out this amount says of June 30. But it seems to be pretty close to the October amount. So yes. So even though the fund lost money, about $11 million, overall the net liability went down about $120 million mainly because of the change in interest rates. So it's very good news overall. Any questions on this page? I got into Kopka. It's just a similar story. The liabilities went down from 2.3 to 2 million. Again, there was claims experience better than expected. Now, Kopka, we don't actually update the census data, unlike the city, because Kopka is a little smaller, so we only have to do a full evaluation every 2 years, and this is a roll forward year, just to try to keep costs down. And also the liabilities decreased a little bit too. So, but overall, again, the net liability went down. So overall, it was good news for Kopka as well. So I'm gonna move on to schedule of employer contributions. This just shows the historical contributions versus our ADC, which is our recommended contribution. Then that's if you wanted to pay the fund off in 30 years. And you can see The city's always a little bit under our recommended, but it's trending in the right direction. It's actually getting a lot closer to our recommended amount. So, I'll move on, and I think it's a similar situation for Kopka. Page 10. Actually, they actually contribute actually enough, more than the ADC, so it's actually in excess. So they're in good shape to pay off the fund in 30 years. Move on to page 11, which shows his city expense. This is amount that you have to put on your balance sheet, and it includes the service costs and interest costs, which I discussed earlier, and it's offset by projected investment income. And then there's these the gains and losses that I discussed earlier. These get amortized over several years, and you can recognize them over time. So because of the gains for experience and the gains and assumptions, you actually have you can actually recognize about 61 million from those two items. So the OPEB expense is actually negative this year, or an OPEB asset. So it's like negative 34 million total. And the next page, Kopka, the OPEB expense is also decreased a little bit from the previous year because of the gains and losses, mostly the gains from experience and assumptions. So that decreased from 146 down to 86,000. So, all right. So, the next pages are just showing the amortization pieces. I'm going to skip over those in the interest of time. So, I'm going to skip to. I'll skip to page 23. That just shows the ADC calculation. I'm not going to spend too much time because you're not actually contributing to ADC, but this just shows the details of how we get there. And then skip to page 31, which shows the population. And since it's a closed plan, I think everyone after it closed as of January 1st, 2017, as expected, the population is gradually decreasing, the active population. So that's shown on this page. And we didn't actually, for Kopka, as I said before, we didn't actually get updated census information this year. We used the prior year's data. Page 34 shows the substantive plan provisions, and they haven't changed since last year, so I'm not going to spend much time on these pages. It's good to review to make sure they're still accurate. Let's see. Then the assumptions say that the only assumption that's changed the discount rate. We used 3.35% last year, and this year it went up to 5.04. And this analysis is as of June 30, so the interest rates have been gone up further since then. So I expect next report we might even use a higher discount rate, so there might be more gains coming. So that's good news. All the other assumptions we kept the same, except for, as I mentioned before, we updated the healthcare trends on page 38. Sorry, not page 9, where is it? Page 40. No, 40, that's turnover, sorry. Where is it? Oh, page 42, sorry. Yeah, page 42, we did a study of the healthcare trends, and we ended up resetting those at 7%. Starting for pre-65 and 6.5 post-65. Now, we're probably going to do a fresh analysis in February of next year, so we might tweak these as more COVID data becomes available. So that, and the effects of the inflation environment. And so we may change the trend rates, for your next valuation, but we haven't done that analysis yet. Page 43 shows the updated per capita costs. They came in a little bit lower than expected. And I think that's about all the important points I needed to cover. And page 48 has just a summary of the most important points. The discount rate changing and the healthcare trends being updated. And I think that's all I have prepared. Are there any questions?
So the bottom line is we went from 18% to 22, and you changed some of the assumptions to look to more based on the most recent experience.
Right.
Okay.
Yeah. And
All right, any other questions?
Yeah.
All right. Thank you, John.
Okay, you're welcome.
All right, I would take a motion to receive the actuarial report. Motion is second. Record your vote. Item passes unanimously. Now we have a number of items here. Starting on number 9. Many of these have to do with our insurance that we help oversee. So I know Mr. Long is here from HR. So if you'd like to come and give us just a brief overview of this.
Good morning, everybody. Okay. So do you want me to go ahead and do all the items as a quick summary? Okay. So basically, item A is our Blue Cross Life renewal for 2023. The main highlight to that is the retiree premiums are increasing to $18.25 for next year. This is a 100% retiree paid benefit. Item B is adding an additional line of service to our contract with Primis. Primis is our medical center operator for our employee clinic. Public Safety has identified a need to provide some services that are required by the pension system prior to being accepted for service as a police recruit or a fire recruit. This is going to be limited in scope to individuals who do not have health insurance, and the goal of this is to remove the barrier to an otherwise qualified candidate. And since OPEB is a party to the original agreement, concurrence is required. Item C is the UHC renewal. There is no increase to premium rates for both our early retirees as well as our Medicare participants on the Medicare Advantage plan. The city will continue to subsidize the premium at 50% for 2023. Item D is the Blue Cross Blue Shield dental renewal. Our premium renewal actually decreased by 5% for 2023, and the premium for retirees is 100% retiree paid. Item E is our Primis renewal. This is the 4th year of a 5-year contract. The estimated yearly total cost for services is $1.594 million. OPEB representation is currently 28% of the population, and the estimated cost of that is roughly $450,000. Item F is another Primis item, and this is an increase in the estimated cost. When we originally did the contract, this was a 3-year contract with 2 one-year renewals, and the previous clinic operator operated on a flat fee basis, meaning we paid a flat monthly fee for them to provide all services at the clinic. When we went out to RFP in 2020, we selected a new operator that instituted a more pass-through model, and what we did not realize at the time is the scope of prescription medications that were going out through the clinic. And so essentially for 2020, we overspent by $275,000 above what we had initially projected. And for 2021, we had overspent by about $135,000. And so the renewal, though, for 2023 in item E does account for that increased spend. And then the last item, item G, is our Blue Cross Blue Shield Medical. Our renewal for early retirees came in at 2%, as well as our renewal for Medicare participants came in at a 6.4% increase. Our stop loss is increasing by 19%. However, we are closing a gap in coverage for non-Medicare retirees as well as their dependents that are covered under the Medicare group. These are our split participant families. We are also adding RX coverage due to the increase in cost in the specialty drug spend. We are also forecasting to see a 28% increase in RX rebates that will be coming back to the city for 2023, and we're estimating that to be roughly $3 million in savings that our consultant has identified. With that, that are all the items. I am open for any questions.
I have a question.
Okay.
Is my mic on? Is a capitated plan an option going forward with this medical center provider, operator?
What do you mean by that?
A per participant per month, similar to the previous operator, that it was more like a capitated plan as opposed to a pass-through program? Is that something that's being looked at?
We could look at that at our next renewal to go back to PEBM. The only thing with that is then we have a hard time pulling out the data to see if they are actually seeing the quantity of participants that we would expect.
The only reason I suggest that is because the operator assumes the risk. So whatever services are provided, prescription drugs, the operator assumes that risk under a capitated plan. So even though they may not be seeing the volume that's anticipated, they are assuming the risk for any costs that are expended over there.
That is a very valid point, but I think what we were seeing with the last operator, especially toward the end, is they were driving down our visits to make their cost
Lower.
lower, yes, to meet within what they had budgeted.
Got it. Thank you, Jason.
All right, you're welcome.
Thank you, Trustee Berry. The only thing, Jason, I appreciate the work that you're doing. Just for the board's awareness, we have partnered with a consultant, Lockton Dunning. Jason had referenced that just briefly in his message, but that holistic review of everything, including the clinic, is part of the review that they're doing, which is where we found some of the savings to the stop loss. So I just wanted to appreciate your work on that.
Yeah, and we're also going out for RFP for medical for next year, and I think some of the discussions will be as to how to integrate our employee clinic with our medical plans to get a better sense of the ROI moving forward.
Thank you.
Okay, thank you.
All right, thank you, Jason. We will have to vote on these individually, so I would entertain a motion on 9A. Motion and second, record your votes. Motion passes. Item 9B. There we go. Motion and a second, record your votes. And it
I just
passes.
want to say, I think this is a great move for those who don't have health insurance coverage, so that we're not losing qualified candidates. So I think it's a great move on the HR department.
I agree.
Yeah.
All right, item 9C is with United Healthcare. And it passes unanimously. Item 9D is with Blue Cross and Blue Shield. It passes unanimously. 9E with Premise Health. It passes unanimously. Item 9F, again, another item with Premise Health. And item 9G with Blue Cross and Blue Shield. All right, now we have item 10, reports, comments from trustees, staff, or interested parties. Have anybody from out there? Okay, anybody on the board?
I just want to apologize for being late. I just completely got distracted in my office. I got no other good excuse. Brent wanted to know, was it on my calendar? It was on my calendar, so it's all on me, guys. Sorry about that.
Okay, you got elected.
Yeah, I know.
That's what happens when you don't show up, you get elected, so now. All right, well, hearing no comments other than that, we stand adjourned here at 11 a.m. Thank you.